Hi everyone, this is Ted Bauman here with Clint Lee with your Money Matters video for this Monday. We're recording this on a Friday, so there's no telling what's happened over the weekend. Unfortunately, every minute matters when it comes to the markets and headlines at the moment. On Friday, we did see the markets opening up a little bit stronger and then tail off again during midday. And probably because the president said he was going to be using powers that have not been used since the Korean War to order U.S. companies to produce goods and services that are required to fight back against the coronavirus. Clint, how are you doing? You're at home with your kids just like me, is that right?
That's correct. Yeah, I'm doing good. All things considered. Ohio schools have been shut down for 1 week now. Look to be shut down for at least 2 more here. So yeah, getting adjusted to life and homeschooling kids to that point as well.
Yeah, it's not easy to do. I've been working home for a long time, so I'm used to it, but I know a lot of people are struggling with it. And on that score, I hope people found useful the Bauman Daily that we sent out the other day about how to protect yourself online when you're spending time online under the current circumstances, which is something that everybody needs to think about. Clint, let's talk about what's going on with this market now. I've even seen some people dispute whether we're actually in a bear market, which seems incredible. But technically, people can argue all kinds of things. Right now, it seems indisputable that we're in a bear market from our top. So let's talk about how long bear markets tend to last, and how quickly they tend to recover. I'm going to flash up a chart, which I'd like you to speak to, Clint. What I want to ask you this, you've done a lot of technical analysis. Looking at this chart, do you see any correlation between the steepness of the drop in a bear market historically and the duration of the bear market, or is it just noisy?
No, I think there's absolutely a correlation between how sharply this market's pulled back and what that means for how long we're going to be in this situation. I found it somewhat ludicrous that somebody would argue whether or not we are in a bear market. We're absolutely in a bear market. Even right now, the S&P 500 is down about 30% from its peak. But right now, something that we talked about the other week, Ted, is the different types of bear markets. Ones that are more event-driven versus something that's cyclical, relate to the business cycle, versus something that becomes more structural, like an asset bubble that creates some sort of credit crisis like we saw in 2008. What's really uncertain right now is if this sort of event-driven bear market becomes more structural, what that means for a recession, because then that has implications, as you can see from the chart, if you're in a recession or not, what that means for the depth of this bear market and how quickly we can ultimately recover.
Well, absolutely. We spoke previously about different kinds of bear markets. Some people call them structural, which is kind of the one we had in 2008-9, which was basically a financial crisis. And under those kind of circumstances, it means that the banks have to deleverage. They have to try to clean up their balance sheets and the credits going on. Seems like the Fed is determined not to have that scenario play out again. So what I'm wondering is, we know that this is an event-driven crisis. In other words, it's caused by an event. But I'm looking at this chart, if we can flash that back up again. And what it reminds me of potentially, and that's the thing that worries me a bit, is the recession that led into World War II. Because in some ways, it's a very similar scenario where we're looking at a decline in demand. In World War II, it was partly because the U.S. government stopped stimulus early from the depression, the recovery of the depression, but it's also because countries are starting to shift to military expenditures. So in that case, we saw a fairly long period of bear market, but the recovery, once it recovered, was dramatic. So let's talk about that. Clint, what about the time to recovery? I mean, or rather the scope of recovery. How much do markets bounce back after they've been down like this?
Yeah, so I guess the steeper the decline that we see, the stronger the eventual bounce back. Now, when you look at sort of all the averages going back, all the historical bear markets, whether it was included with a recession or not, your average bump about 1 year later was 47%. But when you start to have these more severe bear markets, these larger pullbacks, those recovery numbers actually tend to start to get a little bit better, which makes sense. The steeper the decline, the more room you have to bounce back and recoup those losses.
And sometimes, of course, markets bounce back even higher than they were before. For example, in 1982, during the recession there, which was caused by the Federal Reserve raising interest rates to try to bring inflation under control, the market went down by about 27%, but bounced back up again to nearly 60% in the year after that. So there are lots of different variables. Now, the key question I guess everybody wants to know is how low can this go? I want to flash up here a chart that shows some projections. And essentially the projections are suggesting that at the end of this year, in the best case, we could be more or less where we were at the beginning of the year, maybe a little bit below it. But in the worst case, we could be 1,000 points below that. What would it take, do you think, for us to be able to get back to the highs that we had at the beginning of the year by the end of this year? What do you think would have to be in place by then?
To get back to the highs at the end of this year, well, yeah. Obviously, I think that is a quick recovery, factoring in a best case scenario where I think for the most part, you're avoiding recession, or at least maybe you see 1 quarter of recession, because in the comments up to this point in terms of the statistics and looking at how deep these bear markets can run, how long it takes to recover, a lot of it hinges on that question of recession. I guess that's something I would ask you, Ted, just being the economist that you are and having your ear close to the ground. You know, when I see the numbers that are coming out, a lot of times, and this is the problem with some economic stats, is that they're lagged. So some of the things that we're seeing, this month in March for February isn't really showing a deterioration, but has there been anything you've noticed that's maybe a little bit more timely recently that would suggest, yeah, we are in a recession, or maybe otherwise we could be avoiding one here?
Well, absolutely. I mean, this morning I read that the weekly jobless claims for the state of Connecticut alone for the week coming up, in other words, the one they're about to announce, were higher than the entire national jobless claims for the previous week. So what we're going to see in the next couple of weeks are a spike in jobless claims that are higher than anything probably we've ever seen in terms of like the quickness of the turnaround, more than we've ever seen in the history of these statistics. Now, what that tells me is that given we're an economy with 70% consumer demand as the driver of the economy, we have to go into recession. People just will not have money to spend. And the money that the Congress is planning to give out, fundamentally, I think that the plans that I've seen are totally inadequate. I'll be honest about that. They're talking about giving away certain amounts of money, but they're not even, they're talking about tax credits. They're talking, they're doing everything they can basically to try to refuse to acknowledge how serious this problem actually is. Which actually brings me to, the next question. I think, honestly, for my money, we are looking closer to the bear scenario in that chart that I showed just now. But we know that there are certain things that will tell us when the market hits bottom. Everybody wants to know what those are. Clint, what's your take? What will tell us when the market hits bottom?
Look, just given the nature of what's driven this decline and the uncertainty, everyone's been talking about looking for the panic, looking for the capitulation. While looking at what these markets have done over the last couple of weeks, I don't know that you can't call that capitulation and panic. Yet we've continued to move lower, in the wake of that. So rather than spending your time trying to guess day to day, is this the bottom? What I would recommend is trying to factor in and monitor metrics that says there's a sustainable rally underway. So instead of trying to guess on a big down day, this is it, I'm going in, instead take a step back, wait to see the signs that maybe a more durable rally is starting to form.
So, all right. So that's obviously what we're looking at now. You and I traded a graph this morning, which we're going to show you now, that shows what LPL Research, it's a very good research house, what they think are the key figures. So this chart is basically saying that there are 5 things. One is that we're confident we've reached a peak in COVID-19 cases. Now, that's not something anybody knows when that's going to happen. So in a sense, that is the basic condition. We need to see a peak and then a decline in the number of cases. The second thing is visibility into the likelihood of a US recession. They say that they think we're almost there. I agree. I think we as I said earlier, we are headed for a recession, and it's going to be a severe one because, as I said, people will not be working, they will not be earning, and they won't be spending money. And it doesn't look like Congress is grasping the nettle there. The third one is that markets have priced in a recession. I think what you've been saying is that that's happened. You've seen a 30% drop. What else would they be doing but pricing in a recession? Otherwise, they would not be doing this. So that clearly seems like almost there, but we don't know whether we're at the bottom. Then we have sentiment and technical analysis, which I'm going to ask you to talk to in a moment, and then we have policy response. So I think right now, what we have is clearly the market's priced it in. We know that there's a recession coming. We don't know when the virus is going to peak. Personally, I think the policy response is inadequate, but we will see. Tell us about the technical indicator. You've got one that you think will tell us when we've hit a bottom. You want to show that graph?
Yeah, this is one of my favorite indicators, and something that I'm going to be following closely to try to ascertain whether or not, we are starting to see that durable rally take place. And so what this chart is showing is a ratio of advancing stocks to declining stocks. So when this ratio is increasing, that means the number of advancing stocks on any given day is moving higher. Conversely, it means the number of declining stocks could be moving lower. And what you're really looking for at this point is an extreme reading. An extreme reading like we have highlighted here. This occurred back in late 2018. As we know, the last significant market pullback we had was in the fourth quarter of 2018. The S&P was down about 20% from peak to trough. And when the bottom was ultimately put in at the end of the year, you saw a rally attempt, and on that rally attempt, you saw that number of advancing stocks participating in that rally spike. And you can see it drove this ratio all the way up to around 18 times. Now, we've had a couple rallies from time to time throughout this week, and we have come nowhere near hitting those types of numbers. So I don't think we're getting the all clear yet in terms of when we have seen these rallies set in. That is a signal I'm going to look for to say, okay, there's a more durable move up that's starting to take shape.
So in a sense, what you're saying is that we would want to see this repeated for several trading sessions in a row. Maybe if we get a week where everything's recovering. My sense is that we will see that when all these other pieces are in place. And of course, one of the key ones is the imponderable. When does the virus spread peak? And we don't know when that's going to be. However, the fact that you've identified a good technical indicator answers a question a lot of people have been asking us. For example, at the Bauman letter, writing in, our subscribers are saying, when will we know that the bottom is in? And so these are the kind of indicators, folks, that we're using. And we're looking at things that have predicted turnarounds fairly accurately in the past. So when we see those things happening, you will be amongst the first to know. Now, there's one other thing that I want to just share with you before we close today, and that is that earlier today, the Secretary of the Treasury announced via tweet, as the government likes to do these days, that the tax filing deadline has been extended to July 15th. So that gives you more time potentially to investigate tax options that can save you money. And I just want to point out that the Bauman letter does have one of its key offerings is something called Pay Zero Taxes. And it is a book that contains all kinds of ways to save on your taxes. We have recently updated it for the recent changes to the tax laws. So if you're considering subscribing to the Bauman letter, this is a good time to do it because you have some more time to implement some of these things that we've collected, these tips for you. So click on the link below and potentially consider subscribing to the Bauman letter. Clint, thanks very much. Things do look dire, but we are looking for the bottom of this market, and we will be using all of our technical skills to identify when it happens. But there are some things that are going to remain beyond our control, and I think we all understand what that means under circumstances like these. Anyway, folks, we will talk to you again next Monday. Thanks very much.